So you are ready to start investing, but you don't know how. And the more you try to look into investing, the more complicated it looks. Like what funds lah, what dividends lah, what equities lah, earnings per share lah, and so on. And there are many different ways to invest, like day trading, options trading, forex trading, and so on. And on top of that, there are news headlines that tell you some guy lost a few hundreds of thousands of dollars in investing, or the stock market wiped out a few $1 trillion worth of wealth.
Wow, scary, yeah?
That's why in this video, I'll be sharing everything you need to know on how to get started investing for beginners, such as why do you even need to invest, how much money you can make from investing, what can you invest in, what are some tips and tricks that you can use when investing. Also, do join my Telegram chat group to discuss or ask any questions that you may have. And with that, let's start with part 1. Why do you need to invest? Short answer, inflation. Long answer, inflation. All jokes aside, the reason we need to invest is because our money loses value over time. So, have you ever heard your parents say,
"Last time my mee siang my ham cost just $2, now it costs $5. So expensive."
That's just inflation doing its thing, where the $100 that you have today will have a lower purchasing power in the future. Then you'll be like,
"But I'm already parking my money in a high-yield savings account that pays me 3 to 4% interest a year."
Yes, they are safe, the returns are guaranteed, but there's just one problem. The returns that you are getting from savings accounts are just too little. So little. Even if you are earning like 3 to 4% of interest every year, it is still lower than the current inflation rates of like 4 to 5%. This means while you are earning your monthly interest, you are still technically losing money to inflation. So that's why we need to invest our money. Because by investing our money, only then our money can grow faster than the inflation rate. So what can we invest in? When people think about investing, they think about a few 100% gains, going to the moon and all that stuff. No, that's not investing, that's just gambling. Investing is not a get-rich-quick scheme, yeah, but instead, it is a smart and safe way of growing your money, if you do it correctly, of course. There are many ways to invest and grow your money, such as stocks, properties, bonds, cryptos, and even Pokemon cards. But perhaps one of the easiest, safest, and most convenient ways to invest is by investing into the stock market. Which brings us to the next question. How does the stock market work? So let's say you have a food store selling, I don't know, maybe rice, vegetables, and meat. And because your food store is doing so well, you decide to open up another food store. But you need more money to expand. So you decide to ask your friends to give you some money. But of course, they won't just give you money just like that lah. So in return, you give them some shares of your company. So let's say the company has 100 shares in total. If your friend Ali owns 10 shares, this means he owns 10% of the company. And if your friend Akao owns 20 shares, this means he owns 20% of the company. Now, of course, for big companies like the fruit company Apple, they have more than just 100 shares. In this case, they have 15.6 billion shares. So if you own one Apple share, this means you own just a tiny part of the company. Like, I don't know, maybe the leg of this table at the Apple store belongs to you. Anyway, because each share represents a part of the company, each share is worth something. If your food store does really well and your company hot big, all of a sudden, many investors want to own the shares of your company. Because there's a higher demand for the shares now, your friends can offer to sell the shares to other people at a higher price. So that's what's happening in the stock market. Stocks go up when there's more demand for the stock and will go down when there's less demand.
Sounds good. Let's start investing and beat the inflation lah.
Ooh, red cards. The market is...
Should you buy Apple because they just came out with the latest iPhone? Should you buy Tesla because Elon said that they will solve full self-driving later this year? Again, should you buy Google, Amazon, PayPal, Nvidia? With so many companies to choose from, how do you know which is the right company? Because if you bought the wrong company, later you lose money how? GG lor! To avoid that, real investors would spend countless hours going through the company's earnings, financial reports, stock news, analyst reports, company's announcement, and so on. But the question is, you got time to do that or not? That's why for beginners, what I would usually recommend is instead of buying stocks, you buy the entire stock market. You won't buy the wrong stock if you buy all the stocks in the market.
Big brain time.
One of the easiest ways you can do that is by buying exchange-traded funds. or ETFs. Not financial advice obviously. Quick pause in case you do not know already. Besides Webull's awesome sign-up rewards, Webull also lets you earn a return on your idle funds. Webull's Money Bull is currently giving around 5.4% 7-day yield for USD, and for SGD, it shows 3.8% 7-day yield. To use it, all you need to do is head over to Menu, Settings, Manage Brokerage Accounts, then change the account type to Margin Account. After that, the change will take up to 2 business days to complete. Once margin is enabled, you can head to Markets, tap on the Money Bull icon near the top, then make sure it's activated. And now, you will start earning a yield on your idle cash. You can continue trading even when your funds are in Money Bull. That's because 99% of the market value of your Money Bull position will be added to your buying power, and the funds from your Money Bull position will be auto-redeemed when you need more cash to settle your trades. Besides that, the funds are highly liquid as you can quickly redeem your funds and withdraw your money from Money Bull within 1 business day. Best of all, Webull doesn't charge any fee for using Money Bull. Also, if you sign up using my link down below, fund any amount while also subscribing at least $500 into Money Bull and keep the money there for 30 days, you will win 25 free shares worth anywhere between $3 to $500 each. Besides that, there's also a Money Bull promotion where you can earn up to $3,000 by funding more and fulfilling the requirements. Webull also launched a new transfer promo, from which you could possibly get up to $2,000 worth of free shares or more by fulfilling the requirements. So if you are interested in trying out Webull, do sign up to them using my link down below. With that being said, let's get back to the video. To put it simply, an ETF is a basket of securities that tracks an index. The most popular index of them all is the S&P 500 index, which tracks the largest 500 companies in the US. So you have companies like Microsoft, Apple, Amazon, Tesla, and so on. Each company will move differently. Some will go up, others will go down, but if you combine everything together, it will all add up to this one number, the price of the index. So if we see the S&P 500 goes up over time, we can say that as a whole, the top 500 companies in the US are doing well. And if we see it go down, we can say, Hong Kong law, lose money law. Now, the special thing about investing into an ETF is that your money is now split across all the companies in the holdings. So, let's say if you invest $100 into the S&P 500 ETF, 7.3% or $7.30 of your money is invested into Microsoft, $3.50 into Amazon, $2.12 into Alphabet, all the way down to like 1 cent into some random company that you have never even heard of. What this does is that it will diversify your holdings. And this is the biggest advantage of investing into an ETF versus investing into a stock. Because if you are investing into one company and that company does badly and the stock drops like 50%, you'll straight away lose 50% of your money. On the other hand, when you are investing into an ETF, even if 1 or 2 or 100 companies does badly, as long as the rest of the companies does well, your investments will do well. Historically, the S&P 500 has delivered an average return of around 12% per year. While this may seem little, especially compared to some crazy WTF returns that you see from stocks and cryptos, just know that 12% average return over the long term is a very good return. That's because it was found that most professional investors, like the best of the best, people who are better at investing than you or me, can't even beat a simple S&P 500 index over the long term. Now, as a new investor, one of the biggest worries that you will have is
it investing risky? Will I lose my money?
Yes, of course there's risk. In fact, there's risk in everything you do. Like, you can just be minding your own business, walking along the road, when some idiot suddenly decides to spit bubble tea pearls at you. While the S&P 500 has a 12% average return over the long term, this doesn't mean that it's a smooth sailing ride all the way. There are some years where it can give over 30% return, other years you can almost lose 40%. But as a whole, when you add up all the returns, the S&P 500 has gone up. That's why it is so important to invest over the long term and not try to in out every day. Like if in the March of 2020, if you saw the stock market crashing by 30% and you decide to be like, I'm out and sell everything, you miss an entire 90% gain after that. The best investment strategy is to consistently invest no matter what. Market up, you buy. Market down, you cry and you buy some more. The term for this is called dollar cost averaging. This is such a simple and yet effective strategy because when you invest and buy in consistently, you are effectively buying less when the market goes up and buying more when the market goes down. If you do this long enough, you will get an average return from the stock market, which generally goes up over time. But here's something to think about. Wouldn't it be wise to not assume that the stock market will go up forever? Because after all, past returns doesn't guarantee future performance. Yes, that's true. But barring black swan events like some alien invasion or World War III or some asteroid crashing into Earth and wiping out humanity, the market will tend to go up. The reason I say this is because I'm betting on the fact that companies are always coming up with new stuff, like a bigger camera or a shinier car or some more powerful chips. I'm also betting on the fact that there's technological advances and we are now able to produce more things faster, cheaper and better than ever before. When you add all this up, you can be more or less sure that 10-20 years from now, all these companies would have earned more money as compared to today, and thus their value would have also gone up over time. Next, if you are planning to get started on investing, here are a few rules that you need to follow. 1. Only invest after you have paid off your high interest debt. By high interest debt, I mean stuff like your credit card debts, personal loans, where the interest can be as high as 10% or more. That's because by paying off all these high interest debts first, it will then be as though you have made a guaranteed return on your money. Second, only invest the money that you do not need in the next 10 years. This is because in the short term, the market can be volatile. It can sometimes go up and it can sometimes go down. But what historical data tells us is that the longer we are able to keep our money in investments, the lower our chances of losing money. And with that comes point number 3. Have an emergency fund of around 3 to 6 months before you start investing. The last thing you want to do is be forced to sell your investments when the markets are crashing left and right. Also, make sure to park your emergency funds in places that can give you anywhere between 3 to 4% return, like your high-yield savings accounts, money market funds, government bonds, and so on. I've talked about it in this video if you are interested. Once you have fulfilled these criteria, only then you are ready to start investing. So then, which funds can you invest in? Here are some of my favorite funds which you can check out. CSPX, which tracks the S&P 500 index that we talked about earlier. QQQM, which tracks the largest 100 technology, manufacturing, and healthcare companies on the Nasdaq index. And VWRA, which tracks the top companies all around the world. As to which broker you can use to invest, you can just check out my low-cost brokerage comparison table to find out which suits you the best. But my tip is, just open an account with every broker on this list, as they will give you some welcome rewards for opening an account with them. And if you are looking for tutorials on how to buy or sell stocks, I've done tutorials for most of these brokers, so you can just check them out. So that was a quick video on how to start investing. Hopefully, it helps you out. Do let me know down in the comments below if you have any questions. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.